My name is Andrea Thompson. I am the founder of Modern Sense, an advice-only financial planning firm based out of Mississauga, but we have planners across not just Canada, but one of our cross-border planners is in Australia. One of the challenges that we often come across when working with our cross-border clients, specifically in the investment planning modules that we do with our clients, is around how to invest compliantly as US tax filers living in Canada. And by compliantly, that can encompass a number of elements. The first element would be, how do I avoid something called a PFIC, or a passive foreign investment company, which is how do I not have to file extra paperwork with the IRS as a US tax filer with a non-registered account in Canada? So what types of things can I invest in? How do I do that without causing extra paperwork, extra filing costs for my accountant? And then how do I ensure that I get the right tax forms to my accountant? Does my brokerage provide the right tax forms or not? I'm not sure. And these are things that we often coach our clients through when we're working through our investment planning modules. And to date, there have only been, that I have known about, two options for cross-border investing: a do-it-yourself approach, where there are a few investment brokerages that you can do your own buying and selling through and create your own portfolio, or hiring a financial or investment advisor who has cross-border acumen and works for firms that produce the right sets of compliance forms for the IRS. And there's been nothing in the middle. And what we have found is that we have clients who are not necessarily comfortable in the full DIY approach because they don't have the time, effort, or acumen to do so. And we also have clients who don't want to hire a traditional financial advisor and pay the 1% to 2% in advisory fees that they don't feel is justified. So it leaves a middle ground that we haven't been able to fill until now. And I came across JustWealth about, I guess, a few months ago now. And JustWealth is a portfolio manager that operates similar to a robo advisor, and I will let them do a much better job at explaining what that means. And they fill in that gap between a DIY investing strategy and hiring a full-fledged financial advisor in the traditional model. So I'd like to introduce Richard Burton Williams and James Gauthier from JustWealth, and they are going to take you through their value proposition today. Modern Sense is excited to bring this to our clients and working in partnership with JustWealth, because we do feel like it addresses this needed gap that exists for our cross-border clients in the marketplace. So I'll leave it at that, and I'll turn it over to the JustWealth team.
Well, thank you, Angie. I appreciate that. You have a presentation, so I'll go ahead and share my screen, and we'll go from there. Let me quickly screen share, and I'm hoping everyone can see this nice and clear.
Yeah.
Perfect. So just to quickly introduce the two of us who you'll hear from today. So my name is Richard Burton Williams. I head up our partnerships, relationships with advisors like Andrea and the Modern Sense team. With me, who you'll hear from as well, is James Gauthier. He's our Chief Investment Officer. He's also a client-facing registered portfolio manager, so he works one-on-one with many of JustWealth clients. And so in his role, he also designs, builds, manages our portfolios. He brings decades of experience across thousands of clients, billions of dollars of assets. And so he will highlight a lot of what we do from an investment management point and some of these more specific concerns that are being addressed today from a US filer perspective. So we have 4 items for you today. We're going to give you the overview of JustWealth. Again, as previewed, we'll talk a bit more about not just what we do overall from an investment management perspective, but paying particular attention to what we do from a US dollar perspective for US tax filers. We'll talk a bit about the JustWealth and Modern Sense relationship and how that works. And don't be shy, we're going to leave some time for Q&A at the end as well. So the next few slides, we'll talk about JustWealth and who we are. I always assume that there might be a bit of a range of investor experience with these types of groups. So we'll go over not just who we are, but also what that term that Andrea used that you might have heard that's widely used in the industry, robo-advisor. We'll go through what that means, hopefully demystify that for you. It's a lot less intimidating than it might sound at first. And especially because we at Just Wealth, we really focus on the people side of the process, not just the robo side of it. Hopefully, as evidenced by the town hall today, there are people behind the robo. We don't want that term to imagine that you're going to be left off in the realm of technology and not really taken care of on a one-on-one perspective as a client. So we're going to dig into a bit about what that means, but also our approach at Just Wealth. So introduce you a bit to who we are at Just Wealth, going left from right here. We were founded in 2015, so we're 10 years in now. We're across Canada, so we work with clients in all 10 provinces, as well as the Yukon. But of particular interest today, we also work with clients who, again, are multiple jurisdiction tax filers. We also have some clients who are situated in the US and other countries as well. From an experience perspective, while the term robo-advisor in the industry might be a bit new or novel, as a leadership team between James, myself, and our other partners, we bring 20 plus years on average of experience in having directed the asset allocation for tens of billions of dollars for Canadians. So our approach to this wasn't technology driven. It was more so from the perspective of having seen how the industry was operating and how could we make it better with our experience and leveraging technology. We think that's a key differentiator for us. Moving on, some of the innovations that we've brought into the industry, like every robo-advisor, it's fully online processes. We think our online process is very clean and easy to use. But one of the things that we do that differentiates us, that's kind of innovative in the industry, is that we put a personal portfolio advisor that we match every client with a registered personal portfolio advisor, someone who is registered with the Securities Commission, who owns a fiduciary duty to Just Wealth clients. So that's one of the things we wanted to focus on from the start, is that the technology is great, but we want to maintain that personal relationship as well that you would typically have in the traditional industry. And we've been recognized as having been one of the leading providers in this space by independent parties, which we're very proud of as well. So what is a robo-advisor? Again, to demystify that term, I like to compare it that it's as simple as if you were to walk into your local bank branch and ask to open up an investment account, you would sit down with an advisor, answer a number of questions, they would put you into a portfolio, and you would go ahead and invest in a mutual fund and be charged a high fee. We do that, but we focus on online automated processes so that we can lower your fees, make it simple, and put it more directly into your hands. The other item that we do that is different from the traditional robo-advisors, but emphasizing again where we wanted to take what still worked in the traditional world and bring it to the robo-advisor world, is that I'm going to emphasize this throughout, we do pair every client with a registered portfolio advisor. So we provide personalized advice for you. We establish that relationship when you become a client. You're introduced to your Just Wealth personal portfolio advisor, and that's who you can reach out to for investment advice as long as you're a Just Wealth client. Call them, email them, reach out to them. They're there to support you in partnership with the team at Modern Sense. So really what we want to do is to surround you with as much support, real people support, as we can. We always emphasize that there are people behind the robo. So just putting it visually, for those of you that are more visually focused, simply what we've done is taken that traditional model, streamlined it. We work with your partners at Modern Sense. We remove the layers, remove the fees, put you into a low-cost portfolio of exchange-traded funds rather than a high-cost mutual fund investment to lower your costs, make it more convenient, and put more support behind you, more personalized support. So if you are new to robo-advisor investing and new to Just Wealth, the question is, who are we right for? So who are our clients? In short, it would be everybody. We have clients across Canada, and as I mentioned, in the Yukon. We have US-based clients in multiple states. We have internationally based clients as well. So we have found that we can work with a number of different cases, a number of different client profiles. We have the right investment approach and investment philosophy to support a number of goals and a range of clients. And in a minute or two, James will get into what we do from an investment perspective and really put that into perspective for you in terms of how we can work with different client types. The average client size is about 150,000 per investor, so individual, not necessarily the household. That being said, we have clients from as little as $1,000 RESP up to eight-figure clients with many different account types, many different investment goals and objectives across their different accounts, tax considerations, you name it. We have an approach that can work for any of those client types. Our average client is about 40 years old, and we have a wide range of investments that you need, account types. So I'll just close with this. I'm happy to tell you myself how good we are and how well we work with clients, but it always feels best to hear that from third parties. And some of the kind of independent observers of the industry, one that we point to is Money Sense. We have been their best overall robo-advisor 3 out of the past 4 years. The Globe and Mail, they do an annual review of robo-advisors, including a review of the growth portfolio, which is most commonly used for most robo-advisor clients. 4 straight years, we've had the highest 5-year after fee annualized return versus the other robo-advisors. So we think that our approach vis-a-vis the traditional industry and vis-a-vis the robo-advisor industry is bearing fruit. It is showing that we are doing something right for Canadian investors, and it's great to have the support of third-party independent observers to emphasize that as well. So with that, I will pass it along to James, and he will give you an overview of what we do from an investment management perspective and focus in on the topic du jour today, the US dollar side of things.
Thanks, Richard. So we'll get into the investment process a little bit. We'll give you high-level details about how we do, what we do, and what we use. But it suffices to say, based on that description that Richard provided you with all of the different client types, we really have to accommodate each of these stages throughout any particular investor's investment life cycle. We've got 18-year-old clients, we've got 90-year-old clients. They're going to be somewhere on this chart. Obviously, not everybody's the same. But we try to think about things as having portfolios that are appropriate for your investment needs no matter where you are on this chart. So how you invest in latter stages of life is very different than how you invest in the early stages of life or the points in between or the inflection points when you shift from accumulation to decumulation. So we offer a very wide range of portfolios, and I think the next slide illustrates how we kind of break down into categories. Oh no, this is the investment process. So this is more about the how we do it. So I've effectively been using the same investment process for almost 30 years now, which explains some of the gray hair. But basically, we break it down into 3 distinct categories or 3 steps. Asset allocation is looking at the various investment classes that we can invest in. So whether it's Canadian equity, US equity, short-term bonds, government bonds, emerging markets equity, you name it, different types of currency exposure. We're looking at all of the available places that we can put client assets and try to determine what's the ideal allocation for exposures to each of these different areas of investing. We take a long-term focus. We try to not get caught up in trends or fads, but focus on what tends to work over long periods of time, using evidence, not hype or sales pitches, to come up with our ideal asset allocation. Every portfolio, and we offer over 80 of them, has a unique definition of what it is supposed to accomplish. And that asset allocation is our solution to finding out the best possible combination of assets to invest in to give you the best chance of meeting those objectives. Step 2 is trying to find what are we going to invest in. We know theoretically how we want to invest it, where we want to place it, but we need investment vehicles to fill each one of those allocations. We tend to use exchange traded funds exclusively in our portfolios. They offer instant diversification at a very low cost and are very good at replicating the asset class that we've modeled our investment conclusions to be. So ETFs have been around for quite some time now. If you look at any articles in the press about the success of exchange traded funds in our country and globally, they are gaining extreme popularity, displacing mutual funds mostly. Mutual funds kind of do what ETFs do or vice versa, whereas ETFs cost usually about 1/10 of what mutual funds cost. So it's the ideal solution for fulfilling what we're trying to accomplish in terms of targeting specific asset allocation. We tend to look at different criteria to determine what is the best in-class choice for every single asset class category that we have. So for example, Canadian equity, we will look at all of the providers, iShares, Vanguard, BMO, Global X, you name it. We'll look at every option available for that asset class and determine a winner based on the criteria you see. What are the fees? How closely does it replicate the asset class that we're trying to replicate? What are the distributions? Are there any tax advantages? What are the spreads between the buy and the sell? And we come up with our definition of the winner for every single asset class. So what we think we have is a best-in-class solution, not restricted to one or two providers. We use 8 different exchange-traded fund providers, none of which is based on business interests or conflicts of interest. It's all the best candidate for the asset class wins. And what that means is low-cost portfolios, ideally what we're trying to accomplish. And then the third part of the process is ensuring that things are doing what they're supposed to be doing. Occasionally new products come around. They're launched by either new companies or existing companies into new asset classes. And we're always evaluating whether something new is better than anything that we currently have or more appropriate. If so, it might displace something that we currently have. We look at our assumptions that we use. Like I said, we take a long-term time horizon, but those do change over time. As interest rates change, as geopolitical things change the investment scene, we will evaluate whether they necessitate changes in our portfolios. And most importantly, we want to make sure that they're accomplishing what they were designed to accomplish. So if we have a high growth portfolio that is not performing well in a high growth environment, then that tells us something's wrong and we need to make changes. That's never happened, of course, but we monitor to make sure that things are doing what they're supposed to do. Then this is the slide that I thought was preceding. It's kind of a two-dimensional illustration of how we break down our different categories of portfolios. So we have what we call our 6 different families of investment portfolios: the growth family, the income family, the socially responsible family, of course of importance here, the US dollar family, RESP target dates, very specific for a particular account type, and then retirement target date portfolios, just a variation of the RESP theme. So across the horizontal spectrum, you see the different risk levels that we categorize internally. Capital preservation being the most conservative category. It's not available in every category, but conservative, moderate, balanced, advanced, high, and maximum are all just different variations of risk for any one of those particular families. So not every category has an option available in each family, but for the most part, they do. So we offer all of these different account types. When you start adding them up, you can understand why we have 80 different versions of portfolios, because to get all of these different objectives satisfied at the different risk levels, you really need this many accounts. The nice thing about this is that you don't have to spend time fretting over which one do I pick. Our algorithm, which is part of our website and part of our process, is designed to do that for you. So by answering the same, 10 to 15 questions that you would do on any online website that assigns you a portfolio online, you answer the same questions, and the sophistication of our algorithm that determines which one of these options is your best choice. I mean, if you indicate you want a US dollar portfolio, you are going to be recommended a US dollar choice of some risk level, depending on your other answers. So it's indicated right on our website when you're filling out the application that Any recommendation that's provided online is preliminary. It's usually pretty accurate, but it's a starting point for you to have as a conversation with your portfolio manager to determine if it really is the best choice. The portfolio manager can add additional context, ask additional questions. You, as the input provider, can provide additional insight into what your objectives truly are. Not every question on our website is going to be, it's not comprehensive. It's the same 10 to 15 questions that everybody answers. If you have kind of a unique point to make, you can bring it up directly to your portfolio manager, and that might influence the choice that is used for your account. Point is, you don't have to do it alone. You don't have to sit and look at a long menu and determine which portfolio you want. Your portfolio manager, using the information obtained from the application, is a starting point, and they'll work with you to determine what the best choice is. So let's talk specifically about our US dollar portfolios. Andrea gave a very good overview at the beginning about the different complicating factors of having to file with two different taxation units, one being Revenue Canada, the other being the IRS. There are some unique considerations, and like I said, we construct every portfolio with a purpose. We don't have 80 portfolios just because we wanted to have a big number. Our US dollar portfolios have a very specific purpose. They operate exclusively in US dollars, for one. They buy nothing but US domiciled investments as the exchange traded funds, for another. And the combination of those two things allows for very efficient operations. You're never losing money on currency conversions, which is common when you deal with a firm and having both currencies as potentially part of your investments. And it allows for the reporting to be done cleanly and smoothly for those people that have US tax reporting obligations. So we mentioned the PFIC word, Passive Foreign Investment Corporation. Any exchange traded fund domiciled in Canada, or mutual fund for that matter, is considered a PFIC, and it requires additional reporting from the IRS, potentially additional costs to you as an investor, and it can be problematic. It's not insurmountable, but it's an inconvenience that is not necessary when you can create portfolios that are 100% US based. It avoids the PFIC regulations or reporting requirements altogether. The tax slips, as Andrea mentioned, our custodian produces all of the required documentation for people that must file returns with the IRS. So the 1099 forms, front and center. We also produce all of the Canadian documentation, of course, but it's the US side that's perhaps less common. So we do rely on them. We're a portfolio manager. The custodian is basically the company that's entrusted with the safekeeping of your assets, the bank, if you will. They do the holding, and that's a regulatory requirement. We're not allowed to touch money as portfolio managers. We just direct the investments. The custodian, and we vetted this when we established this business 10 years ago to make sure that they could handle the reporting of U.S. tax requirements. Another one that I don't think we mentioned, but if you're a Canadian resident and you own U.S. property, you will also have to file T1135 information on your Canadian tax return if you own more than $100,000 Canadian worth of securities or assets in general. So we are able to provide tax reporting for T1135. So those are really, I think, the main criteria that are needed for US tax filers living in Canada. So we tick all of those boxes. As for the portfolios themselves, we offer two different versions of the US dollar portfolios, what we call our growth-oriented portfolios, or those that are focused on accumulation. And then we also have our income-oriented portfolios, which offer the ability to generate high amounts of income, usually for the purpose of distributing on a monthly basis. So they're more of a decumulation focus, whether it's a RIF account or even a non-registered account. We offer both families. So unlike a lot of firms that offer a range of portfolios like we do, you have typically conservative income-oriented portfolios or aggressive growth-oriented portfolios, and you've just got that one kind of family. You can't get aggressive income portfolios, and you can't get conservative growth-oriented portfolios. Well, we offer the full spectrum in both. So we offer from conservative to aggressive on the income side, conservative to aggressive on the growth side, all depending on what you want to accomplish. So what we offer on the US dollar side is often better than what most Canadian firms offer on the Canadian side in terms of being able to tick as many boxes as possible. So other things that are worth mentioning with respect to US dollar portfolios, as Richard mentioned before, we're not replacing Modern Sense. You take the guidance and direction on how to evolve your assets over time. We're just the investment provider. We've got the tools to fulfill the investment side, whatever direction it takes, whether it's a tax angle, income from different account types. We're happy to take and accommodate all of that advice and incorporate that into how we administer your accounts over time. The tax reporting we already talked about, they do come from the custodian. I will be upfront in noting that I know the tax filing deadline for the IRS is a little bit earlier than it is in Canada, mid-April as opposed to end of April. The tax filing, the production of the 1099 slips is kind of in the latter part of when our custodian releases the different tax slips. So they release them in batches. You know, the RSP contribution slips come first, and then, you know, the T3s and then the T5s. And so the 1099s are towards the end of that list. And it's usually about the end of March when you get that information. It's downloaded directly to your investment access. So you as a client can go into your online access and either, you know, print off or download your tax form. You don't have to wait for it to come in the mail. And then you can forward it off to your accountant, or if you do your own taxes, you've got the information you needed. It is delivered quickly, but like I said, it comes late in the month of March, and that only leaves a couple of weeks. And there's not much we can do about that. That's just the nature of how the forms are produced here in Canada.
James, if I could just interject there for a minute, that's pretty common across many service providers for the 1099 forms to come out in late March that I've seen in our practice as well. I do want to make special note of the 1099B. If you're talking to other service providers, most service providers do provide 1099 div and 1099 interest forms, or INT forms, which are covering off your dividend payments and your interest payments. But most firms do not provide the 1099B. This is your capital gains reporting for the IRS. It's completely different than the capital gains reporting that's required for the CRA based on the way that capital gains are calculated in both countries. So this particular form is what I think makes JustWealth stand out in this area, that they are able to provide this through their custodian. And just to clarify, your custodian is CI, is that correct, James?
CI Investment Services specifically,
yeah.
Yes.
Yeah, so just wanted to make note of that in case anyone was wondering who the custodian was, but that's a really key differentiator. I know that if many clients have gone to Wealthsimple, for example, and they said, oh yes, I get my 10, they don't get the 10B form. That is not provided by the major robo advisors in Canada. I have not found one to date, so that is a major differentiator that I just want to make sure I point out.
Thank you. Other point we didn't mention, so for non-registered accounts, we can accommodate in-kind transfers. If you were thinking of moving to JustWealth but happen to have a collection of either individual securities or funds within a US dollar account or a Canadian account for that matter, we are able to accept in-kind transfers for any taxable account, and we will work with all clients on managing the transition to an appropriate JustWealth portfolio, realizing gains only as you see fit. We don't force any client to realize any realized gains that they don't want to, whether that's managing it over different tax years, using losses to offset gains. You know, we're happy to accommodate what you're comfortable with, recognizing, you know, that there might be tax reporting requirements that take precedence, or investment priorities that take precedence, but we're willing to work with you, and that's an important consideration because some companies will only accept in cash transfers, which could result in a very unpleasant, unexpected tax bill. So I know that US dollar portfolios was the emphasis, but if many of you are Canadians and have an RSP account or other account that might be invested in Canadian dollars or a family member that might be interested, we do offer the different portfolios, and we just put some information on the different families here. So the growth family, you know, they're the accumulation portfolios. That's the majority of our client base that are still in accumulation mode. Most portfolios are invested in the growth-oriented portfolios. These are typically the kinds that are every institution offers these. So it's not that different. Just about every account type can use these on the Canadian side. But that's kind of the most popular, and that's ones where we're often compared against others, and they show us at the top of that performance list. These are the portfolios they're looking at. On the next slide, I think we have the income portfolios. So this is more about the decumulation stage. People that require a monthly income from their investments, whether it's a tax sheltered account or a taxable account, we can set a set amount of withdrawals, a fixed amount, say $1,000 per month. Send it directly to your bank account on the first of the month, every month, just like a pension. And the income portfolios are ideal for this because they generate anywhere from 4% on the conservative side to very close to 6% on the aggressive side of income, reliable, steady income from month to month, to allow for those withdrawals to be made just based on the income that you're generating in your account. So we don't ever have to sell anything. At some point you might start taking out more than what we could reasonably generate. And of course we would have to sell things, but what you don't want to have to do is sell securities at a low point in the market just because you need some cash in your account. So the income portfolios go a long way to defer that risk to the point that in a lot of cases we don't have to ever sell anything. So it doesn't really matter what's happening in the markets because that doesn't affect the income in your portfolio. So ideal for people in retirement. ESG portfolios, environmental, social, and governance. These are unique in the sense that people who strongly believe that they don't want to invest in anything that's unethical in their view. These portfolios are using the strictest criteria that we have available to us to eliminate investment in adult entertainment, alcohol, fossil fuels, gambling, tobacco, and weapons. Those are the 6 criteria. We can't say anything about anything else because the portfolios that we create, they don't all adhere, but they do have those 6 in common. So this is not, some of the wishy-washy ESG approaches that say, we screen out some of the bad ones. These portfolios attempt to screen out every bad one. So that it really is pure and consistent for those people that are looking specifically for that. We don't think it's for everyone. And you might have to compromise on the amount of growth or the amount of income that you can generate or tax efficiency. But if this is your top priority, we've got a family available for you. The target date approach, very popular for our RESP. We receive a lot of positive reviews and press comments about how unique this approach is. RESPs are a little different. They have a very predictable 18-year cycle. So if you have an RESP for kids, no matter where they are in their stage, we always have risk-appropriate portfolios so that you're not taking too much risk as you're getting close to having to pay the bills, and you're taking an adequate amount of risk when you have a long time to invest in the account. So it's a very intelligent and logical way to manage the assets in a prepackaged format, which makes it very easy for the individual investor. So the tax-efficient portfolios, this applies only to Canadian dollar portfolios, unfortunately. We can't create anything tax efficient for the US because we just don't have the vehicles in the US. We have different tax codes. So there's nothing that can be done on the US side. But if you have a non-registered account in Canada, we have portfolios that are designed to maximize after-tax returns. So there's no other online provider in Canada that offers tax efficient portfolios except for us. So the idea is, we've got all these accounts, all these profiles that you can use for RRSPs and TFSAs, which are the most common account types for every Canadian. But for a non-registered account, taxes matter. They're not deferred or eliminated like they are in a registered account. So what we try to do is mimic the risk level that we have in our registered account equivalent. So for example, the JustWealth Global Balanced Growth Portfolio will create the JustWealth Tax Efficient Global Balanced Growth Portfolio, which has the same level of risk, but we alter the composition either at the asset class level or the different ETFs that we'll use that might have some kind of tax advantages to allow us to create similar portfolios, but ones that should achieve better returns on an after-tax basis. So it's a pretty innovative concept, and I've been doing it for years, but no other firms seem to have caught on to this. So if you do have taxable accounts in addition to US dollar accounts that are domiciled in Canadian dollars, these could be good solutions for you. Back to you, Richard.
Thank you, James. So I'll just close with the last few slides about the JustWealth Modern Sense relationship and how you can work with us via your Modern Sense advisor. So it is, I like to describe it as a tri-party relationship. Your primary relationship management comes from Modern Sense. They'll refer you to JustWealth. We'll handle everything on the investment side. Meanwhile, your Modern Sense relationship won't change at all. They'll continue to be your day-to-day go-to for financial advice. They'll bring in the other experts as needed to the relationship, whether that's from a tax perspective, you name it. And at the same time, they will have an online portal where they'll be able to view your investments and really stay on top of what's happening with you. So we're providing with them with as much information as possible about you to be able to stay on top of things. And I'm really trying to create a teamwork type of relationship to manage your money and your financial plan. When it comes to fees, we do provide you with a discounted management fee if you are referred to us via your Modern Sense advisor. We like to think of it as a two-part fee. The first part is the JustWealth management fee. If you come to us directly, our standard management fee is 0.5%, so 0.5% per year. If you come to us through the Modern Sense relationship, that fee is lowered to 0.4%. So it's a low fee, which gets lowered even further. The second part of the fee is the fact that we use exchange traded funds to create our portfolios. There is an MER related to the exchange traded funds that we use in our portfolios. On average, the ETF companies that we use, they charge about 0.2, and that's taken directly from the ETF. So every holder of that ETF is charged that fee. We don't touch it. It's taken directly out of the ETFs. And so if you think about someone in the average portfolio paying a 0.2 MER to the ETF companies and 0.4 to JustWealth, your all-in fee is going to be 0.6%. And so not only do you benefit from still having that independent, unbiased advice from Modern Sense, you then get what we do, which we think is a best-in-class, independent, unbiased investment management approach. You get that at a lowered fee as well.
Richard,
again,
I'm going to jump in for a second. I couldn't find the raise hand button.
Just cut me off, James.
Mention the US dollar portfolios actually have substantially lower fees. They're on average about 10 basis points. It's economies of scale of some of the US vehicles, the big Vanguard portfolios, they're very low cost. So if you're interested in just the US dollar portfolios, that number's approximately 0.5%.
Add on to that as well, just to clarify for clients, Modern Sense takes or receives no referral commissions for this relationship. This is a completely neutral transaction for us. We are simply just trying to set you up with a portfolio manager that is able to best handle your needs from a US investment perspective. So we don't receive any commissions. We don't give any commissions. I just wanted to make that, abundantly clear for our clients.
Wonderful. Appreciate that. So just demonstrating what that impact can be on your portfolio. Again, as I mentioned, I think the visual side of things helps to put it in perspective. Just looking at the cost savings, it can be meaningful to you over time, whether or not you factor in performance. So leave that aside. We never want to just pitch on that, but the impact of the fee savings, I think, is meaningful. So next steps, if you're interested in learning how to work with us, please reach out to your Modern Sense advisors. We're currently working with Andrea as well as with Vicky Brown. If you did want to open up an account, they have specific landing pages that we set up with them. But we would recommend the first step to please reach out to them, learn more about the relationship, how things work with us at JustWealth. And with that, we are happy to give up the screen and move on to any Q&A that folks have questions for us.
Feel free to use the chat function at the bottom if you do have a question. So I have a question. If one of our clients who happens to be from the US decides to move back to the US, you mentioned that you have some US clients. Are you able to continue to work with them once they move back, or what does that look like?
Good question. So we are not registered with the SEC in the US, Securities and Exchange Commission, which means we have a limit to the number of people that we qualify under an exemption to allow us to manage. That number is 15 for all of the United States. Each state also has its own policy. I've never come across a state yet that says you are not allowed to manage money for a non-resident. But New York, for example, has a maximum of 6. So we do keep a running log of how many we are at, and we're actually above 10. So we don't have a lot of capacity, but as long as we're under that 15 threshold, we can accommodate people who move back to the United States.
Yeah, that's great. And what types of accounts are you able to manage once someone goes back to the US, for example?
Well, as long as they leave them at a Canadian institution, I mean, they have to. If they decide to, expatriate, then they have to take their money across the border, and you'd have to find a U.S.-based provider. But as long as you're willing to leave your assets with a Canadian institution, they can be transferred to our custodian. Whether they're in Canadian dollars or US dollars, that doesn't matter. We can accommodate both. The key thing is that we can only send money to and from a JustWealth investment account to a Canadian domiciled bank. So as long as you have, one of the big 5 or any of the other credit unions or major institutions in Canada, you can maintain both a US dollar bank account and a Canadian dollar bank account if necessary. Money can go to and from those banks with no problem. They can't cross the border. We can't send money to, one of the IRA accounts or something like that.
A question from a client: if I transfer existing securities, let's say ETFs and stocks, in kind from a US institution, how do the logistics work of selling those to eventually convert to your portfolios? Can I log into the website and click sell, or would I have to phone you? How does that work?
So the transition from an external account to a JustWealth portfolio is handled between the client and the portfolio manager. There are no self-directed options. You can't go in there and sell your own securities. It has to be done through the portfolio manager. So basically, we come up with a transition plan that you're comfortable with. So maybe it's transitioning over a couple of years. Maybe you want to keep one of the securities on the side. For whatever reason, we can continue to do that. We're only going to sell securities when you're comfortable with it, and then the buying will be in whatever JustWealth portfolio we believe is the right portfolio for you.
And maybe just to clarify for my own edification, is a client able to transfer directly from a US-based financial institution to JustWealth?
So we can't take like money from a 401k plan.
Right.
I don't think those can cross the border.
No, but let's say it's non-registered, for example.
Yeah, so a non-registered account, we should be able to accommodate. It's rare. We don't get many requests for that, but if it's as long as, a Morgan Stanley or a Schwab or something like that, if our custodian is willing to allow transfers from them, if they can coordinate with them, then they could cross the border in a non-registered account.
I think one of the benefits that I do want to point out about having your non-registered assets resident where you are, because often what I'll see is clients will leave non-registered assets in the US while maintaining their Canadian residency, is number one, ensuring you get the right tax reporting for both jurisdictions, which you can get with JustWealth, for example, and you can't get, let's say, with a Schwab. They'll only produce your US tax reporting. And secondarily, if you want your Canadian estate planning to ensure that it covers off your non-registered account and non-registered assets, which are resident where you are, then you want your assets to be where you are. If you live in BC or if you live in Ontario, your will is covering the assets that are resident in that province. So if your assets are in the US, usually you'll have to either have a US-based will to accommodate those assets or have special cross-border wording in your Canadian-based will to cover off those assets. So it can just make your estate planning slightly easier if you ensure that your assets are resident where you are. And if JustWealth facilitates that transfer from a US-based institution in kind, then the tax ramifications of that ought to be nothing. Any other questions? One thing to clarify is, does a client have to have the same portfolio in each account?
No. We are limited to one portfolio choice per account. So you can't have two portfolios on one account. But if you did want, say, two different strategies for a non-registered account or a TFSA or any other account type, we can always just create two accounts.
Yeah.
So there's no limit to the amount of accounts that you can create, but our rule is there's one portfolio for each account.
Okay. And do you have an app? I know everyone loves to do personal finances on their phone these days. So does JustWealth have an app?
Yeah, Richard, can you show them?
We do have an app, and we can give you a nice preview now also of what the online client portal looks like.
Thank you so much. This has been a great overview, and I really appreciate both Richard and James's expertise they brought to the table today. And we think this is going to be really valuable for not just our US tax filer clients, but any of our clients who are looking for a solution that they have not yet found. And I do think that JustWealth brings that to the table very nicely, very cleanly and simply. So I want to thank you both again today. Thank you everyone for your attendance. And if you have any questions, you can direct those to either myself or Vicky, depending on who you work with, and enjoy the rest of your day. Thank you so much.
Thank you, folks. Thank you for the time.